Hi everyone, welcome to another episode of World of Oil Derivatives. I'm Greg Neman, the Chief Executive Onyx Capital Group. I'm joined today with Vincent Wu from the research team. And just wanted to remind you guys once again, please like and follow this podcast. If you're on Spotify, click the bell to get the notifications, and please subscribe to YouTube. That's starting to do better and better, and more people are coming to watch this live, and this is, watch it in person. This is recorded every week, and we show graphics more and more now. We're doing more of that, so it's more of a, I'd say, a better experience face to face. Get to see your lovely mug. And please, again, guys, if anything you have or want to reach out about, want to discuss, we'd be more than happy to have those kind of inputs and feedback. So please don't hesitate. Right, let's get straight into it. Again, more of a market-focused podcast again for us. Interesting times, isn't it, Vincent? I mean, if we just frame things, last week, all was calm in the geopolitical world, or as calm as it can be, really. And we were more talking about weakness in products coming in, and flat price being a bit, stable, but like semi on the way down. And then quite a lot has changed since, right? So we want to just frame the audience from that point of view.
Yeah, so since last week, a lot of things have happened. It's more volatility as usual. So it was about the products, refinery margins coming off, and then bearish EIA stats showing weaker gasoline demand, gasoline builds that triggered a very bearish reaction in both Alba futures and Brent, which came off by $5 in a day. So that collapsed to the low 80s. Previously was around the 90s. And so you can see on the screen here, last week it was on slowly coming off, came off by like $10 from week on week. And then over the past weekend, tensions in the Middle East, Hamas attacking Israel, and all of that triggered some more escalating this conflict. So again, a bullish reaction by the markets on Monday morning. So Brent, it seems like crude flat price has reset higher, but the question is our prices going to be supported at these levels? Is it going to go up? Is it going to go down? There's a lot of uncertainty, but what we can say is the narrative has definitely shifted from, more for product, for macroeconomic focus to a geopolitical focus now.
All in the space of a very brief amount of time. So
yes.
I think when there is mayhem, it's good to just take a breath and take a step back so we can, know where we're coming from, where we're at. So just in the space of a week, as you said, a very aggressive sell-off, like $10 per barrel. As we were talking more about approaching $100 per barrel, people getting excited about that, and then there being resistance to that. So all of a sudden, an incredibly powerful sell-off. So a huge amount of volatility. And then to add to the volatility, we have a weekend event, and a weekend event is always tricky for the market because, the exchange ultimately where 90% or odd of oil trading takes place is closed as of 11 p.m. London time on Friday. So people having to wait the whole weekend to trade, and then opens again 11 p.m. Sunday London time, and inevitably it was going to have an immediate reaction. I think people must be finding that frustrating on the one hand, but on the other hand, this is so common now. We keep getting weekend events. So this kind of gap up in the open, it's actually something that we used to talk about with trading as well. You get to Friday, and it actually, from a risk reward point of view, it's better to be long than short in case something kicks off over the weekend. Better to be flat as a primary choice unless you have a position on. But you're always a bit wary leaving yourself short on a Friday night because something could happen over the weekend, and then it would just immediately gap up on the Sunday, and then you got all this volatility to ride out. In 2019, we had the attacks on Saudi Aramco, 10 million barrels offline. That was over a weekend, and that was a $10 rally straight away. We've had countless things happening last year, of course, around the Russia-Ukraine crisis and the very tight physical market. So it just really adds to the volatility. But on the flip side, if we actually take a zoom in now on the reaction from the market, we were talking about it on the trader chat. We were talking about it as a group. There wasn't a huge amount of alarm, I would argue, from the traders and from us and the research. And I would probably put that down to, it's not directly a producing region. Conflict in the area is not a new thing. It was very much emphasized. Its importance was emphasized in the media. It needed a bit of background research. You need to figure out exactly what was going on. But my personal opinion was that it wasn't hugely, it wouldn't be hugely impactful to oil because the geopolitical premium, I think you did a video about it, the geopolitical premium concept has actually died out in the last 10 or so years, and we've talked about this on our podcast. So having said all of that, we rallied quite significantly. We went from around $83 per barrel, was it? And then jumped up to about, I think maybe 88 at the peak, or 89.
88.
Yeah. And then we're kind of back off a bit now. That's a pretty substantial reaction. And for a geopolitical event, because as you say, there's nothing about producer nations in there at all. So for it to be a purely geopolitical rally and a risk premium, that's a return to things, to a concept that I personally haven't seen for maybe even 7, 8, 9 years. Usually it's a genuine concern. For example, when Trump and the Trump administration was battling with the Iran situation in the Straits of Hormuz, again in I think 2019, flat price didn't do anything. In fact, I think it even sold off. It just didn't react. And I think the market's kind of going, look, we've got enough oil in the world at the end of the day. So any perceived risk, we can absorb it. But I guess it's flipped now because we're in a tight physical market that actually the perception is, no, any risk is genuinely a risk. And we can't take any more offline than we already have from the OPEC. Or you could just say that it was a market that was clearly short. So people had to kind of short cover, getting more and more short with this $10 sell-off. And suddenly they were caught with this headline. So it got rallied all the way back type thing. I mean, what do you think?
Could be as well. You have both the fundamentals and the financial flow side of things. So of course, a lot of people were coming into, a lot of shorts were coming into crude at the moment. Previously had profit taking flows, but of course, like a lot of bearish headlines coming out. So with this, the media, the narrative is talking about, like, on the geopolitical side, the risk premium comes from the situation with Iran. So of course, there was some speculation. Okay, what if Iran becomes involved in this conflict, and then what if geopolitical tensions inflame over there as well? Because of course, in the Middle East, you have Saudi Arabia and Turkey allied with the US, of course. Like with their political situation, they're having a normalization of relations with Israel. So they're talking and saying, okay, maybe Iran doesn't like to see that. So these are all just speculation, but the premium lies into there's a lot of uncertainty with Iran's role in this, and potentially what might happen in the future. There might be worst case scenario, 1973 oil crisis, or perhaps proxy wars coming out. So I think it's perhaps, going back to 10 years ago, that's, of the Middle East, potential for conflicts to escalate. So perhaps that's a risk premium. It's a flashback to the past. But of course, you can also have a lot of shorts in the market, and then they're seeing this. And so, gotta cover their shorts, gotta cover their positions.
And we'll know from the evidence of the CFCC, I guess, or we can get a bit more of a clearer picture as time goes on and we get the data. But from a positioning sense, what do we mean by geopolitical risk premium? And I think it's got to be, the definition of anything being priced in is that the traders that can position themselves have positioned themselves a certain way on certain information.
Right.
So how many of the traders that could be long got long on the basis of the geopolitical risk premium? I think my suggestion is, my personal belief is, with what was going on before, and with the kind of shrugging off of a lot of geopolitical focused things, that there aren't a huge amount of longs out there that are long on the basis of the geopolitical risk. My understanding would be more legacy length that got caught on this $10 per barrel sell-off are either saying it's a good time to add more, or I think most likely CTAs and the guys who are kind of coming in to sell because there's a bearish momentum gathering have had to immediately get out. And that's the fast money concept. You're someone who's willing to sell and hold, buy and hold for a long time. The buy and hold is already in play. So I don't believe they really had that much ammunition to buy more, or at least exclusively hold a position, because they were already long. And then the shorts who were short are either long term and they're just still waiting this out, or they were fast money and they were just trying to capture the momentum, and they've got to be out because, if you're quick to get in, you're quick to get out. That's kind of their strategy. So I'm talking CTAs, I'm talking day traders, or short-term traders.
Yeah. So seeing like the just quickly taking a bit of quick profit, and then seeing now that the risk reward is undoubtedly still skewed to the upside, especially in the context of a very tight physical market, because you also saw the Brent spreads, DFLs all rally supremely as well.
That is actually a good point. There was quite a good reaction from the underlying structure, which was also selling off towards the end of last week. So that is actually a very fair point. And I think people need to remember, when we're trading even prompt Brent spreads and prompt DFLs, it's still deferred, which is still priced to even more deferred physical oil. So the point is that trading month one, next month's oil, next month's derivative contracts are actually at least 2 months forward physical. So it's speculative on the physical as well. When people are buying and selling that physical oil, it's in the future. So even the physical traders need to take a speculative view on this, right? It's not like they're clearing all the barrels 2 months in advance. So they have to take a position on the physical barrels, wait until it comes to delivering, the time to deliver and market them to refiners, and they've got to have a degree of confidence on that or not. And I think that's still massively up in the air. I think there's still legacy length there for sure. I mean, the market's still tight. We're still very strongly backwardated in physical. So it's actually it's an interesting one, because there's a few different things at play. And again, we've kind of maintained for the last few weeks a bit of uncertainty on crude, and just seen like it's clearly uncertainty equals volatility, and it's all just been about volatility based trades for us. And that's kind of panned out, obviously, but things happening we wouldn't have expected, but that's the kind of nature of the market. Even when something happens like the Hamas invading Israel and it being all over the news and whatever else, it's still unclear where we go from here, and we've still got the rest of the year to see out. Another thing to add is that, have you noticed when we have these weekend events and then rallies the Sunday night after, that it's never really a good trade to buy that price that it opened at. So it opened and got to say like 88. I think it might have got 89 at one point on Brent.
I think very high, not quite 89, like 88.50 around. Yeah.
But either way, when it opens, the exchange mechanism, right? They have to say, when this opens, we are going to match the buyers, match the sellers.
Yep.
And wherever the liquidity for the pre-orders, so you pre-order buy, you pre-order sell, and the exchange open price is a sum of all those orders, and where the price needs to be to satisfy those orders, those net orders.
Okay.
So the buyers overwhelm the sellers, which you'd expect in an event like this, and then to satisfy all those sell orders from the pre-order buys, we got to 88.50, let's say. And then I'm making the point that if you look back in the last few years on all the weekend events, buying that price, say 88.50, where it opened, there never seems to be a good trade. So I think more of the market are aware of that than maybe, I don't know, some people think. And we certainly come off $1. But as you say, like, it's still up in the air where we go from here, because it has held reasonably well, but it's not 88.50. Do you see my point?
Yeah, well, I mean, for now, it's reset high a little bit, but afterwards, you have the existing length, seeing that, okay, they're in the money, or, seeing like, okay, now it's a good time to take some profit. So that's I imagine why prices would be coming off a little bit.
But how do you take profit? Buy at 88.50.
Oh, no. I mean, like, if you already had a long position earlier, like from last week. So
that's interesting. So I wouldn't call that taking profit necessarily. Or maybe it is if they bought low enough. But I say based on recent historical prices,
right,
it's more likely they got burnt on this $10 sell-off. Now you're going, okay, so I got completely burnt. And there's a bit of, denial there. You're like, classic things going on when you're losing a position. And then you get this weekend event. And you're like, okay, great. So it's going to rally back. And then you watch the rally back. And it's like, well, it's only a few dollars and I've lost 10. So if it's not going to rally based on the physical market we have right now, the physical crude market we have right now, at the end of the day, it's a crude contract. And if we're not going to rally based on a geopolitical risk in combination, then maybe this is a good time to sell. And as you say, because you've got a $3-4 rally relief, let's put it, you're like, okay, do you know what? I'm going to sell. So it's like a dead cat bounce, but the cat's not that dead because it was a geopolitical It's got meaning behind the rally.
Yeah, they're just minimizing their losses in that sense.
Yeah, and it's a good decision, isn't it? Right? Like you're like, well, right, rationally speaking, I didn't see this $10 per barrel sell-off happening, but I did think it was a bit over the top, and I still see the same things that I saw before. I still see a tight crude market. I still see the horizon being bullish. So I'm just going to hold on. But then you get like a really bullish event geopolitically, and the reaction is okay, but not amazing. You're like, do you know, it's harder to hold on to a risk when you've been given another opportunity to exit. That's my point.
Yeah, so previously it's just like the fundamentals didn't really change. It's technically still a very tight market, as we can see in the physical and the Brent spreads and whatnot, you know. But then it's just a flat price. It seemed like, you know, people weren't expecting it, or it just seemed so like the $90 support was just seemingly built on a house of cards. It just collapsed so suddenly and so violently. So I suppose a lot of people in it wouldn't, you know, they would feel that, okay, it's not worth holding that position, so that's a good time to exit.
Pretty much. And where do we go from here? I think we kind of said it all in the sense that we probably agree with the market in the sense of the hesitation that we can continue to rally, because we broke through the 90. We didn't get the rally we would have expected with such a tight physical crude market. And now that we've had a reaction we've had on top of that from the geopolitical, I don't really see how this goes any further. If anything, I think we're at peak volatility. I think volatility probably dies off now. I think you've had all the information caked in. You've had all the uncertainty. You've had stopping out on the way down. You've had maybe, as you say, more people able to get out of their length or stop out because they've been given this new opportunity. So I think with less positioning in the market from a speculative point of view and a bit more of a wait and see mode and people going more into the basis like time spreads, differentials, volatility probably comes off now and we probably settle into an 85 to 90 range.
Yeah,
probably, that's fair?
Probably more, yeah. Probably flat price settling down and then more focus on the time spreads.
Nice. All right, let's move on. Refinery margins, you know, that was a focus for us last week. Products coming off, and that was probably the main forward-looking bearish indicator. Because at the end of the day, refinery margins are, you know, the forward prices. We've had another sell-off, haven't we? Kind of across the board.
I'm just pulling up Flux. So what we got up here is our in-house refinery margins dashboard. So looking at the week-on-week change over the past week, we can see that this is looking at Europe, where margins have continued to crater over the week. So a $3.35 decline week on week in the front month. So despite flat price coming off, we can see that this time it's been driven by, of course, you have gasoline coming off, but then gas oil market capitulating as well. So on the back of weak physical demand in Europe, you know, barge premiums declining, as well as just weaker sentiment in general, as well as a speculative length in gas oil futures exiting as well over the past weeks. You have a recipe for very bearish action. Although the notional crack is still sort of supported in the high 20s, it's still very significantly lower compared to past weeks. And something that people were saying was that perhaps it was also demand destruction at these very high flat price and crack levels.
Yeah.
So demand destruction at these very high flat price and crack levels. So in a sense, the market had been rallying so much, longs in the money, and you know, in hindsight, it's easy to say that it was due for a correction, but I suppose the decline in Brent flat price sort of provided the liquidity event, the justification for.
Yeah, that's an interesting point, because last week we were kind of saying it's actually quite a good time to buy cracks because it's been a product-led sell-off. Yeah. And then, you know, what you exactly as you just said, as you'd expect with a really significant downward move in flat price, you would expect the cracks to have a slightly inverse reaction at least to a move like that. And it didn't. It actually outpaced the sell-off in Brent. So that is unequivocally a product-led sell-off, which is pretty alarming actually for the fundamentalists, I would argue. And our particular focus was gasoline, right? We felt like there was going to be some length building up, or there is length being built up, and we can see that in the positioning in the gasoline swaps.
Yep.
I think there's some spec coming in, long-term spec coming in on gasoline, good attractive levels to be long. But it's, you know, sold off another $3.50 odd in EBOB since that. So I guess it's more of the same. I mean, the gasoline market is no stranger to buying dips, continuing to buy as the market comes lower. So I guess we'll continue to see that. So I guess we maintain that view. But the surprising one for me is gas oil. It really is outpacing at like quite a significant rate. And we're completely resetting, like you said, about the historical ranges. You know, $40 on a gas oil crack was 2022's like kind of supported level. And then we had it again in 2023. I think that is a really high crack historically. And there's not that much going on. And then particularly when you say you get demand destruction, the power and gas scenario is not really looking alarming. Carbon prices are getting lower. Is there much of a reason for us to be so high on a crack? So it feels like we're just resetting on gas oil, and we just need to get used to the idea that, as you said, at $20 per barrel, that's still a good crack historically. You know, I've seen gas oil, you know, $10, $8 quite normally for a while. So we could easily see more downside on the gas oil crack, and it's just a bit of a rebalancing. But then the refinery margin can't get absolutely destroyed, because then we'd get demand destruction in crude, or maybe that does happen, but you would expect it to relieve over time. So at the end of the day, the world still needs products, and we still, you know, have quite a low supply situation with crude. So I think the focus still has to be on gasoline. And I guess if you need the net margin to be, you know, healthy or like at least profitable to keep the refiners in the game, and if the market has to reset to allow for that, we probably expect, or I'm suggesting that we should expect gasoline to be the one that corrects the most. Gas oil maybe to continue its sell-off, but for that to be offset with gasoline and the light ends rally maybe. You know, again, like naphtha has been a real dog in the market on the crack basis for a lot of the year, and that's, you know, looking interesting. But then maybe that passes on to your trade idea, because you were just saying before.
Yes, trade idea would be going, there's good risk reward and going long in the Gasnaph. So just actually pulling something up on our dashboard. So this is quite interesting, seeing the open interest in Q1 in Gasnaph 2024. So you had open interest that was significant market interest. You know, a lot of participants putting risk in here. Open interest almost 10 times above its 5-year average. And then just recently, as Gasnaph collapsed, you saw open interest come off so much by around like 30-40% week on week as well, just during the sell-off. So you can imagine it's a lot of so from our trading split, of course, you have on the sell side, this is what the market is doing. So a lot of sell side blending interest, and then recently seen a lot of buybacks, so perhaps potentially taking a lot of profits.
Have you got the price chart on that as well?
Yep, on Gasnaph. So this is just over the past week during the same period as well. So very steep, almost a $50 drop in price.
Okay. And where are we on absolute level?
On an absolute level, November around 107, saw some support at $100 levels exactly.
Yeah. Okay. So there you go. That's actually, a good hypothesis. So you're essentially saying, you know, the market short Gasnaphs, they've massively, do we have like the average price that we think the market got short at as well? That's quite good information as well. But it looks like the market got short, good levels, you know, again, very, very high historical levels on Gasnaph. The market has done very well with that short. And then what are we saying? Basically now there's buybacks coming in, they're taking profit. And then if you think about gasoline probably being oversold on a crack basis, what you're arguing. So then you're just translating that into, well, people are going to continue to take profit on gasoline, and there's going to be support on gasoline crack in general. Then we're low enough on the range on Gasnaph that actually that's the best place to put your trade right now. That's effectively what you're saying. Yeah,
so on a relative value basis, there's good risk reward and going long here. So yeah, as you mentioned, correction in gasoline as well as continued weak sentiment in naphtha.
Yeah,
especially if, you know, fundamentally the blending interest is, you know, is sort of coming off, as well as like weak cracking demand, and of course so it was interesting to see that, of course, maybe naphtha might be supported because of on a lower flat price basis, but it was seen that during the Brent sell-off, which naphtha cracks are inversely correlated with crude, naphtha cracks did go up a little bit, but not as much as expected. So it went up by around $1 into the -12 to -11 range, where it saw more selling interest. So
you still think there's a bearish positioning bias on naphtha?
Bearish positioning, yes. So the length seems rather fickle, I should say.
Okay, well then, good, well reasoned. And there's another one to watch you put in the notes here, right? So we've got, what is it, the front LSTFEI?
So this Audrey was looking into the LPG market, so looking at further going short in LSTFEI. So That's also quite interesting one. So I'll put up the.
So this is US propane versus Asia propane, essentially.
Yes, exactly. So another very volatile week as well. So you saw both. It's almost been a function of the freight prices relating to Panama Canal logistical issues, and then you have the fundamental stuff combining that with financial flow. So a lot of market volatility in here. So very historical low levels, minus 335, and then coming up by $60 in a week.
Yeah.
So last week we did see freight prices, BLPG, come off from around $170 per metric ton down to around $100. So the sell-off was quite intense because there was a liquidity drought because of the Chinese Golden Week. A lot of players were out, so there wasn't much buy-side resistance, and so that supported LSD FEI, that pressured FEI significantly, as well as the BLPG. But once players have returned, we have seen a retracement upwards. So on the screen here, just showing the C3 East-West, which has notably recovered. So it's seen massive swings.
We talked about it. So the liquidity drought that we expected because of the Chinese traders being out because of the Golden Week, did come through, right? We had an East-West sell-off kind of across the board, and the ARBs as well into Asia. You're saying propane. And then it's a decent rally back, essentially, as the Chinese have come back. Not altogether too surprising, but hopefully traders profited from that, because I guess, it's probably reasonably expected. Maybe people even trading into that to kind of exacerbate it. So what do we think now? We think, are you making the point that liquidity improving again, that we should continue the longer term trend?
Yes, with liquidity coming back, we're continuing the prevailing trend.
Which is what, sorry again?
Which is going long an FEI structure. So short LST FEI.
Oh, so the East-West in naphtha and fuel, I think we were talking about that before. Those had a sell-off and they rebounded. And it's the opposite for LST FEI, is it?
Yes, so more selling coming in the past 2 days, and then the market is seemingly looking to add more risk. So with liquidity coming back, it could be a good trade to get into. So continuing on with the current trends.
Cool. So that's some good niche stuff tackled there. Long Gasnaph, looking at the kind of ARBs and East-West again as liquidity comes back. Refinery margins, pretty interesting. Again, we still maintain a view that gasoline probably needs to retrace. We think that's a good area to focus on, whether it is the Gasnaph or the crack or whatever else. So flat price, again, it's the same thing. It's a bit of a cop-out in a way, but I think volatility now set to die down. We had a decent spike with the sell-off, and we've had a retracement now. And I think, with the positioning where it is, if anything, people are removing their length, I think is the evidence. Less at stake now. Shorts maybe have taken profit. So I think volatility is probably should come off now. So we settle into the 85 to 90 range. That would be my view. Others might have slightly different. But anything else to add on that?
Yeah, so flat price, a lot of uncertainty, but it's in an equilibrium right now. Volatility will be coming off. We don't see, there isn't much more room for prices to go up. Perhaps it's in the spreads and the DFLs, some time spreads. But at the same time, the geopolitical risk premium means that the downside is limited as well.
Well, and the underlying crude structure being where it is. So it's like, it's a whole other podcast ready to get into like the difference between structure and products and where it can go next. But I think it's definitely the main thing to watch. How did Brent spreads, DFLs react? How does the physical crude market react now that margins are a lot lower? Now that we've had this big sell-off and now slight retracement, do people just get out of everything and we reset? Do we have to have another conversation about what the long-term view is on physical and the supply and demand situation, and how do people position getting into the end of the year? We've still got a few months left. It could be an interesting one to watch over the next week and talk again with a bit more certainty next week. But again, like traders out there, like it's a difficult time undeniably. But I think, great stuff getting in there, Vincent. So thank you for your time, and thanks for listeners out there. I just want to quickly mention, I think we're both a bit clogged up. You're ill and I'm just feeling a bit so as we're talking I was just noticing it was a bit like nasal. Really? Sorry for listeners out there, but we did our best. And as I say, please reach out, any thoughts, any feedback, willing to hear it, and tune in again next week. Thanks again.
Thank you.